Hey there, it's Michael from optionsplayers.com, and I wanted to get a quick video out this weekend regarding, I'm not going to call it an opportunity, but it's an issue that I see in the market that I thought I'd relay to everyone here in Options Players so that maybe you don't get into trouble, or certainly so that you become aware of what is going on in the market, where just knowing a direction or thinking you know a direction may not be enough. Also going to take the opportunity to introduce you to the upcoming swing trading course that will be beginning on the 22nd of March. First things first, I do want to get a disclaimer out there. Everything I present here is educational. We are not broker-dealers, we're not investment advisors, services, so on and so forth. Screenshot this and please read it. Everything I present here is educational and for case study only, for paper trading. And there is definitely a high degree of risk in trading. Okay, so what I'm going to do here is I'm going to give you a brief intro to the Options Players Swing Trading course. And then I'm going to do a comparison of weekly charts of Netflix and Disney. We've had a lot of talk in Options Players chat about Disney and coronavirus and stocks that might be good stocks during this time where everyone, I guess, basically is wanting to stay home a lot more than go out into public. And then I'm going to focus in on the Disney Daily, and I'll show you what I kind of go through when I start looking at doing trade plan development. I'll just focus on Disney. I'm not going to say that this is an opportunity or not. In fact, I'm not going to give you the trade plan. I'm just going to show you some issues with any kind of trade today. And then also just present why directional prognosis really isn't enough in today's market, especially with regards to volatility. So the swing trading course coming up is really designed for, well, first of all, people like myself who live in Asia, but also people who work during the day and really should not be entering and closing trades in the same day. They could be called into a meeting and suddenly their trades go sour, or possibly even get caught trading by their bosses and get fired. So this is really an overnight trading style. It goes from one to anywhere from 1 day on up to 3-4 months in options positions. Session 1 starts on March 22nd on a Sunday evening on Eastern time. And we've got an 8 session, actually 9 session. I'm going to give a bonus session in here, and it's going to be a weekly, except for the first week. I want to get some intense study on option strategies. So we're going to have another session on Thursday the first week, and then we'll start going off on Sundays. Obviously, during Easter, we're not going to do Easter Sunday. We're going to delay that for 1 day on that Easter weekend. But we'll be doing this on weekends so we can take a look at the previous week's charts and look forward to developing real-time case studies. And the reason is, as far as swing trading goes, at the end of the day, trading is really all about keeping your risk as low as possible and still make money. And we've seen a huge volatility in the marketplace, and I know a lot of people lost money. A lot of people have made money too, but we really need to make this as stress-free as possible, especially when we're swing trading and we're in positions multiple days and things gap. So the reason I do this is I live in Southeast Asia. I've got a full-time job during the day, and I just happen to wake up a couple of times at night and just kind of check on my positions. But I do all my trading outside of hours, or at least my orders. So I trade the U.S. equities market options market, and that opens at 10:30 p.m. and closes at 5 a.m. in the winter, which is right now, or 1 hour earlier in the summer. It's impossible for me to be present 100% of the time during the market open. Obviously, I need to sleep a little bit. And this could be your case as well. You could have a full-time job if you're in the U.S. or possibly you're in Europe, and you're not able to be present in the marketplace 100% of the time. So should you be day trading? Absolutely not. Day trading, you're going to get into trouble. There's a lot of people that want to day trade, but they cannot devote minute by minute into the market. And if you can't devote minute by minute into the market, you should not be day trading. Okay, so that's opening and closing multiple trades in the same day, scalping, things like this. I categorically do not do it because I need to sleep. Okay, so as far as the option strategy for swing traders, what this course is it's short-term strategies that buys and sells options, whose underlying stocks have technical indicators that suggest an upward, downward, or flat trend in the near future. And then they're going to have a duration anywhere from 2 to 60 days, but often they're going out even longer, up to 3-4 months. Trades are usually going to have between 2 and 30 days, but again, sometimes they go a little bit longer. Technical analysis and decision making is done after hours, and decision making for exit is made either in the last 30 minutes of the market open or after hours, or they're just plain automatic. I would say most of my trades are actually exited automatically with preset orders. Okay? As far as what do we do in it, this is going to be useful as we look at Netflix and Disney, is we need to take some steps into swing trade, and we need to follow this. This is really a systematic process that I like to go through. First of all, I like to do a technical analysis. Now, I'm not a fundamental guy. I'll admit it, possibly to a fault, but I'm not a fundamental guy. I'm a technical analyst. So I need to know, first of all, what is the stock? First of all, I need to sort a stock. What's my target stock? What's my prognosis for that stock? Is it going to go up? Is it going to go down? Or is it going to go sideways? And if I can determine that, then I need to do something else. If I think it's going to go up, where is it that I'm wrong? So my hypothesis is going to go up, but where can I prove that hypothesis wrong? It's very scientific. And then thirdly, what is the price target? Where is it going to go? Yeah, I need to have a target. Is it $130? Is it $287.67? What is the actual target? Fourth, what's the time target? We're dealing with options that expire. So I need to know, when is it going to get there? So where is it going? Is it going up, down? Where am I wrong? What's the target as far as price? And when is it going to get there? Once I know these four things, I go in and I'm going to choose the most profitable and probable option strategy based on 1 through 4. Now, that's with a big caveat here. I need to understand volatility. I need to understand a lot of other things to understand what kind of option strategy I might want to pick. And these are kind of some of the things that we're going to go through in the swing trading course. Is we're actually going to go into the market every session and we're going to find these candidates, and then we're going to go in and we're going to design the strategies. We're going to learn about the strategies, butterflies, calendars, just straight calls, straight puts, spreads, put spreads, credit spreads, so on and so forth, iron condors, things like this. But we're going to choose the most probable and probable option strategy based on 1 through 4, based on the current market conditions. We're going to write a trade plan. And those of us who are trading real money, well, I can't really say we're going to trade real money. We're going to actually trade paper trade. We're going to enter the order. And if that order is filled on Monday, Tuesday, or Wednesday, we're going to monitor those trades each day at the close or after close versus what the plan is. If it falls outside of the plan, which is 1 through 4, then we're going to close it. If we hit our target versus plan, we're going to close it. Okay, and that's going to be at the end of the day, or possibly the next day, or possibly it's just going to close on its own because we already have orders in. Okay, so what I'd like to do is let's do a little bit of a battle between Netflix and Disney. Everyone's talking about coronavirus and how everyone's got to stay at home, and what are the stocks that are going to, which stocks are going to actually be helped. What are people going to do as they're stuck at home, or if they don't go outside as much anymore? And there's been a lot of debate in options players chat about Disney. And I'd just like to throw up Netflix as well. I just want to do this little battle between the two. So what I like to do on weekends is I like to look at the weekly charts. So this is a weekly chart of Netflix. And you can see that actually, besides this up here, we do have almost like a triple top going on here, almost a quadruple top. And we've come up from a weekly perspective, and we've kind of slammed up against that. And despite all of this weakness this last week, Netflix actually has held up pretty well. And so the big question is it going to keep going up to go up here, or is it going to come down there? I honestly don't know. I can't tell you where it's going to go. In fact, I don't have a good prognosis on this. And from a weekly perspective, especially in today's environment, I'm not really sure that I would actually look at forcing a trade here. In fact, I don't like to force trades. If I was going to do anything, I would do that, just from a weekly perspective. But again, I don't want to go specifically into very specific trades here. I just want to say, look at it from a weekly perspective on weekends. Now let's look at Disney and let's compare the two, because maybe we want to get into a position from a streaming company. Maybe that's something that we want to do. And again, I'm not saying I want to do that, but let's look at Disney. Well, Disney from a weekly, I've actually drawn in. There's actually kind of a long-term channel going on, but man, this chart is messy as all heck from a weekly perspective. We got huge jumps here, we got a huge jump down here, but it is maybe this channel. This is really a really long-term channel. You're going back to 2016, and it's very wide. The center kind of holds up, and it kind of hit the bottom of the channel, and then also maybe we're kind of hitting some resistance down here right around the 115. It came back up. Of course, this is weekly. So what is the prognosis here? Well, from my perspective, in my steps to looking at trades, starting from weekly perspective, I can identify something very clear for Netflix, and I can identify something very clear for Disney. For Netflix, my prognosis is down. Where am I wrong? Well, I'm wrong at 385. If it goes above 385, my prognosis for down was wrong. Okay, when's it going to get there? It's really tough to say that from a weekly perspective. So I'm going to have to go into the daily on this. I won't do that on this one. From a Disney perspective, also prognosis. Where is it going to go? Well, my prognosis here is it's going to go up again from the daily. Where am I wrong? Well, obviously, if my line is correct, I'm wrong kind of right in there. Okay, so obviously if it did not go up as I expected and actually goes down, I'm wrong and I need to get out of this trade and take a loss. Okay, so my prognosis is that. When's the time going to be there? Well, I don't know. I don't know how long it's going to take to get there. We need to go into the daily chart to actually see that. So what I'm going to do is I'm just going to pick one of these. Again, I'm not going to favor one over the other. Someone could take both, whatever. But we need to go into the daily to take a look and see, hey, is there really anything there that I can really clearly identify and confirm where my upward momentum is, if it is going to go up, where am I wrong, and also take a look at some time targets. So let me just go look at that in the chart. I'm going to be using a software package called Profit Source. And what I have is I've got that same chart with the channel, but I now have the daily. And you can see it's really messy. Okay. And, I can expand this thing out, whatever. I can take a look at a longer term. And what I'm saying is I think that Disney is going to go up. Well, how long is it going to take to get there? I really have no clue. I just don't know. But where is it going to go? Well, look on the daily, and you can see that there's clearly been resistance right around in there. So maybe I can set my target at 130. And maybe I can take a swing on this that says, you know what? Maybe it might get there by earnings. Maybe it actually might get and fill this gap. Maybe it'll fill that gap by earnings. Earnings is somewhere around in there. Okay, and there's also a gap here. Gaps do like to get filled. So that kind of puts me right in the middle of April if that slope is used. So, again, I'm not saying this is right or wrong. I'm just going to say this is what my theory is going to be. It's going to go up. When's it going to get there? It's going to get there probably by, let's say, around 4/17, so April 17th. Where am I wrong? Well, I'm wrong, obviously, when that gets hit. If it starts closing, keeps going down and starts closing down there, obviously I was wrong in my prognosis. So I've got those three. So then I need to design some kind of option strategy. Okay, so we go through this in the swing trading course, but this is live info. This is from, so I'm on the 1st of March right now. In April's coming up. We're about 49 days, 47 days out to expiry around here. So can we design a strategy that would take advantage of our upward prognosis, a target of right around $130 for Disney, and by roughly the 3rd Friday of April, right around in there. Okay, but then we need to know a couple of other things as well for us to be able to do something. Okay, so what is it that we need to look at? Okay, so first of all, here's my steps in Stringer. What's my prognosis for Disney? It's up. Where am I wrong? Well, that ascending trend line. Obviously, if it went below that ascending trend line, I'm going to get out of this. I'm wrong. Okay, let's just be categorical here. You know what? I screwed up and I'm wrong, and so be it. We all are wrong in trading. We can never be right all the time. What's the stock price target? $130. When's it going to get there? Well, I'm going to take the 3rd Friday of April. It is April 17th. Now what I want to do is I want to choose the most probable and profitable option strategy based on 1 through 4. And this is something that we're going to be doing in the swing trading course. And of course, we need to be aware of a lot of things. And this is one of the real reasons I wanted to get this video out today, is because of what's happening in the marketplace. Once we choose, we're going to write a trade plan. Then we're going to enter an order. If we're filled, we're going to monitor the trade each day at the close or after the close versus what our plan is. The second it goes off plan, we're going to get out. The second it hits our plan, hits our target, we're also going to get out. And we're going to be happy with what we got. Okay, so this is what I wanted to bring up. Okay, so this is actually an overlay of the Disney chart. This is out of Tom's Options Tools. And I've got the price action. And then I have the implied volatility. Okay, the implied volatility is the red line. This is the 7 to 30. I mean, we'd be going for options a little bit longer term, so it'd be a little bit lower than this. But what I want to demonstrate is there is actually one thing that is highly predictable in stocks, and that is that implied volatility always goes up into earnings and crushes outside of earnings. It goes up into earnings and it crushes outside of earnings. It goes up into earnings and then it crushes. But what do we have now? We actually have an implied volatility that has equaled the last earnings, which is actually a relative high on the earnings. And we don't even have earnings. The implied volatility is sky high. And we need to understand what the effects of implied volatility are on trading strategies. And I can tell you right now that if you buy a straight option and if you buy a straight call and Disney indeed goes up like we think it's going to go up, what is going to happen to the implied volatility? The same thing is going to happen to implied volatility as happens when you have an earnings, and that sucker is going to come crushing down. Kaboom. And what this chart is it shows you the effect of implied volatility. Again, this is from Tom's Options Tools. If implied volatility crushes down to what we call the statistical volatility, which is about a 50% decrease, and the price doesn't go anywhere, we are going to lose $200 in this trade, almost $200, just from the volatility crush. Now we have to get a pretty good increase in the stock with our deltas in our options just to be able to get a break even. So if the stock goes up and we're in a straight option, we're not going to go very far because of the volatility. And of course, we can look at this. If the volatility goes nowhere, a straight option, we need a certain increase. With this particular, I'm not going to say which option it is, but with this particular option, you're going to need to have the stock go up for us to be able to get up to a double. I always like to look at a double right here. Okay, so by expiry with this particular option, you need the stock to go to 130, 170 to get 100% ROI. Okay, and this is 49 days out. Now, there are other strategies. And again, I'm not this. By the way, this is a straight call. Okay, that's a straight call. Volatility comes out of it, and you lose that right there. Okay. I also like to look at other strategies. Okay. Now this is another strategy, but obviously the volatility. If this is a bullish and this is a bullish trade, I won't say what it is yet. If the volatility comes out, now you can see that the lines are a little bit less steep. Okay, so if we get volatility to come out of it, it's going to lose a lot less. Okay, so this particular trade actually is a call spread. Call spread. Okay, so it's buying one strike and selling another strike later on. When you do that, you're negating some of the volatility. But I've got another, and also we do have doubles. So the difference with a call spread is that if you get a rapid movement up, it doesn't increase in value as much as a regular call. But if you do it over time, you don't need to get as much of a rise to be able to get a double or to get a higher profit than you would with a call. So it costs you less. The next type of trade is really what I love on this. Okay, so this is actually, if you think about it, here, the volatility comes down. What happens here? What we've done is we have completely offset the volatility crush. Completely, absolutely gone. Okay, we don't have a volatility crush in this particular trade. Okay. And it's a specific type trade. It's a directional trade, just like the call and just like the call spread. But the volatility crush does not affect it unless we come way, way down, and that's not something we're going to want. Okay, so obviously, if it comes down into that level, which it probably will, if the market stabilizes and Disney does start going up, that's what's going to happen. What this is this is a directional butterfly. So understanding volatility is really, really important. And understanding what volatility is going to do. And I can tell you right now, if this stock or if stocks start going up, volatility is going to come down. You are going to have volatility crush, and it is going to be harder to make money in existing calls. It's going to be a lot easier to make money if you have a butterfly. Okay, so these are some of the things that and again, I'm not going to say what specific trades they are. I just wanted to demonstrate understanding the market and what's going on in the market, understanding the different strategies and how they work in different environments is what we do in swing trading. Having those understandings, looking at the market, getting our prognosis, getting our target, understanding where we're wrong, understanding our time target, then we can go off and we can design strategies like this and choose one over the other. In a low volatility environment, I love to have just straight calls. In really, really high volatility, I love butterflies. In medium volatility, I love to have spreads. If I can set a target, if I understand when it's going to get there, and if I can also have my own prognosis of where I'm wrong, so I can get out at a very low loss. Okay, and of course, butterflies don't double. You need to get the time working on you, but you only need to get up to $124. Okay, so that's that. Like I said, the swing trading course starts on the 22nd. So I hope to see people come on in there. It's a lot of fun. I never know where it's going to go. We start fresh with doing paper trade account with a certain amount of money, and we just see how it goes forward. We track everything over basically a couple of months, and it's a lot of fun. If you do want to take a look at this, you can email steve@optionsplayers.com, or you can register directly on the education site, the edu.optionsplayers.com. You can do that direct, or you can email me as well. My email is michael@optionsplayers.com. Okay. Well, there it is right there, Michael. So along with our other instructors, Greg's, Mike, and then also we have Steve. Greg's got a great course coming up here, I think this next week as well. So wanted to leave it at that. Hopefully this is useful to you. Be careful out there. I'm personally not putting a lot of money at risk in this very, very high volatility environment because it's just got a lot of things that can go wrong. Thanks.